playable on a regular machine, but I need to preserve the quality of the tape for editing. So what I'm saying is it will be available if you need to review part of the lecture. Okay, well, what I want to do today is first introduce the guests, as usual. Yes.
I have today with us R.J. Sinisi. He's working with the Dispute Analysis and Corporate Recovery Group at Price Waterhouse in New York. He's winding up his global tour of the nation, visiting various MBA schools, but he assures me that he really wants to be here.
Well, last stop.
I have Mike White here with me today. I'm sorry. He's from New Jersey, working with a consulting firm there, and went to Davidson for his undergrad. And his wife is actually in the area, so I think we might have a good chance of convincing him that this is the place to be.
And we have Will Perry. I'll let him give you his own 15-second bio.
I work with Ernst & Young Consulting. I am living right now in the Tampa, Florida area, and I went to Vanderbilt undergrad.
We have one more. This is Mark Davidson. He worked for Apple and most recently Pacific Bell in their preventative healthcare division. He's from San Francisco. And his interview is this afternoon, so if any of you have any pointers,
Smart.
Anybody else? Okay, well, what I want to do today is to get through some more bond valuation stuff. We're not going to be able to finish bond valuation today, but we'll get most of it done and we'll finish up on Monday morning. And I will hand out, I think what I'll do on Monday morning, I'll hand out options and I'll try to get the futures printed out too. So we'll have all of the lecture handouts before the midterm exams. Okay. So everybody notices that the bond valuation handout is at the back if you don't have it already. People don't accept.
Jason.
Pass it down. Guys need some back there? Okay. Anybody need
These has back. Thanks.
Yeah, these are all
I want to pick up where we stopped last time, and that is to use the zero coupon bonds to value some cash flows. And actually, last time we did that graph, that fancy color graph also that I put up right at the end. We had different maturities and different interest rates. And we noticed that the 1 year was pretty flat, and the 30-year bond was quite steep. It's kind of where we left off, and I said to kind of go ahead on the value of the cash flows in zero coupon bonds. So that's what I want to start with today. And suppose that we've got an investment that we're considering, and it's got very special cash flows. The cash flows are guaranteed, and they're $10 in the first year, 20 in the second, 30, 40, 50 in the last year. And basically what I need to do is to determine how much that project is worth. It might be a project that the firm is considering investing in. It might be an investment vehicle, you know, like a strange bond that delivers these cash flows. I need to know what they're worth. So what I'm going to do is to calculate the present value of the investment in a way that's a little different than kind of the formula-based method that I suggested last time. So remember, last time what we would do is we know what the cash flow is, we know there's a formula for present value. V0 equals whatever the cash flow is divided by 1 plus R to whatever the period is. We can just plug through and get the value of this investment. But we're going to do something a little different. We're going to construct a portfolio of zero coupon bonds today that exactly mimics the cash flows from this project. And this table shows how to do this. So we've got $10 coming at the end of the first year. If each zero coupon bond is a $1 face value bond, and if we purchase 10 of those bonds today, then we'll get $10 for sure at the end of the year. So in doing that transaction, we've replicated the first year's cash flows. We can continue to do this with, we've got $20 at the end of the second year. So it's a matter of buying 20 two-year zero coupon bonds. And it's going to deliver 20 ... to 5 years, where we need $50. We buy 50 zero coupon bonds today. So what we've done is constructed a portfolio today that has the same cash flows as this project that we're trying to value. So I guess what we could do is to open up the Wall Street Journal and pick off the zero coupon bond prices. And suppose I've done this, and I've actually just constructed this example here. But this kind of shows how the mechanics of this work. So suppose that the price of the 1-year zero coupon bond is 88.5 cents. So I need 10 of those, so it's going to cost me $8.85. The 2-year bond is priced at 78.3 cents. I need 20 of those, so it's going to cost $15.66. And just keep on doing that. And these are just cash flows out today to construct this portfolio that replicates the cash flows I'm interested in. And it turns out that the price of transacting to construct this portfolio is $96.96. And basically, I'm going to argue that that's the value of this project of 10, 20, 30, 40, 50 over 5 years. And I guess the intuition behind this is one of the fundamental principles in finance, and that's this principle of no arbitrage. Suppose that this project is going for the price is like $90. What's going to happen in the market? People can do this exercise. They can replicate the cash flows. They can see that the exact same cash flows are worth 96.96. So suppose it's being sold for 90. What are the dynamics? Yeah. What happens when people start to buy?
Raise the price up to that.
Somebody else is going to say, well, I'll give you 91. Somebody else is going to say, well, I'll give you 92. It's just going to keep on going until we get to 96.96. And if you're lucky enough to buy it at 90, that's an arbitrage profit. You got something for 90 that should have been 96.96. And if it's priced at 105, who's going to buy it? No one. You're trying to sell it at 105, no takers. If somebody takes it, that's fine. That's good for you. Make some profit. But more likely scenario, nobody's going to buy it. And you have to drop the price. And drop the price. And drop the price until you're at 96.96. So just the natural forces of the market, supply and demand, interact. So the basic principle holds. There's no arbitrage, or very limited arbitrage. This is how the market mechanism actually works in this case. So what we've kind of done is establish what's behind present value. So it's not just a formula where, well, here's a cash flow and you hit it with a discount factor. It's not just that. The way to think about it is the way I present it in terms of, well, how much does it cost to create a portfolio that exactly replicates these cash flows? And by the principle of no arbitrage, these cash flows must be worth the same. Like today I can open a Wall Street Journal and get these prices. Now I've assumed that this is a risk-free project. What happens if there's some uncertainty with the cash flow? Can I use the same methodology? See some shaking heads. Yes?
Yes, but just to be less accurate, you have a good chance you be wrong. You use it. You use anything you want.
Yeah, I guess that's true. I can use anything.
Use a baseline.
Use the baseline,
Well,
and
from there you assume that the price would have to be cheaper if you take on additional.
okay, so that's so I like that. So the baseline, if the cash flows were fixed, then the price would be 96.96. But they aren't. I know that they're uncertain. Therefore, there's no way I would ever pay more than 96.96. It's got to be less, and the degree to which it's less is going to be related to the uncertainty. That's what you would do. Yeah, I like that. Yes.
You're just trying to find an instrument that had basically the same amount of risk as what you're trying to go after.
So we could use the exact same methodology.
Right.
The exact same methodology. And suppose instead of government bonds, I chose a corporate zero coupon bond that had approximately the same risk. That's going to be better. And are those bonds, those prices of zero coupon bonds, going to be more expensive or less expensive than the government? Less. Lower price, higher rate of return because of the risk. So the price or the value of the project is going to be less when you introduce risk. But this methodology is a very general methodology. It's a very standard sort of way to value in practice. You've got something that you just can't open the paper or look on your Reuters screen to see the price of, and it happens a lot. How do I value it? Well, I try to value it by constructing a portfolio that has the identical cash flows, or very close to identical cash flows. And I construct that portfolio with things that I know the price. Put it together, and I know the price of the instrument I'm trying to value by the principle of no arbitrage. So it works quite nicely. Okay, so I'm going to use this replication a lot. Now it turns out that I cooked the prices of these zero coupon bonds, and you can see here that they're based upon 13% rate of return for every single one of the bonds. Turns out that's pretty unlikely. That interest rate, well, 13% interest rate we haven't seen in a while first, but what's more unlikely is the 1-year rate equals the 2-year rate equals the 3-year rate. This is what we call, and later on we'll talk about this, a term structure of interest rates that is flat. So the rates are the same across different maturities. But we don't need to have this assumption. We can have whatever rate is the going rate used in this type of calculation. And also, let me remind you that the caret means superscript in these lecture notes, and the underscore means a subscript. This kind of idea is very important for valuing instruments. It's very important for this idea of capital budgeting. And let me just give you a brief intro to capital budgeting. There's a whole lecture note on this called Project Evaluation. But let me introduce some terms. Let me also mention that some finance terms that I might say kind of just slip out without giving you a definition. So if that's the case, you can stop me or go to the glossary. So if you have like 3,000 terms up. Somebody in the previous lecture said, what is the basis for? And I think that's in the glossary. But if it isn't, tell me and I will put it in there. but the usual lingo in bond trading is that 100 basis points equals 1%. So if interest rates move by 100 basis points up, they might go from 6% to 7%. And 1 basis point is obviously 0.01%. So those things are available. But let's talk about capital budgeting. The idea that we've done so far is to take the present value of certain cash flows. When we combine the present value of all of the cash in minus the present value of the cash out, or revenues minus costs, we get to something known as the net present value. So the net present value always takes account of what you actually pay to get into the investment. And in general, the corporation likes positive net present value projects. These are the types of projects that move shareholder value upwards. As soon as you invest in negative NPV projects, the share price is going to go down. So you're always looking for the positive, the things where the value of the revenues exceeds the value of the costs. And we always do this in terms of present value. Now, there could be situations where management undertakes projects that have negative net present values and undertakes them rationally. And let me give you an example. This is not something I suggest you do, but it's an example. Suppose your firm is on the brink of filing Chapter 11. And you've got one last chance at an investment project. It's got a negative net present value. However, this investment project, there is a chance, and maybe it's only a 5% chance, of a blockbuster payout. Really big payout. And we actually do all the discounting and the expected values. This is a negative NPV project. But if perchance this 5% scenario occurs, we're, instead of on the brink of Chapter 11, we're in good shape. So all of the incentives exist there for management to take a crapshoot on a project that's got negative NPV. And this is something you have to be aware of as shareholders. You want to avoid situations like this. And bondholders, especially within the corporation, will have it written in great detail in bond covenants to avoid situations like this. So the management is basically acting rationally in their own self-interest. And they're going against the interest of the shareholders. Because as soon as this project is undertaken, the share value should drop. If it turns out the 5% scenario occurs, the share value will go up. But we always base our assessments on expected value and net present value. So here's an example of a project that cost $100 million. And we've got what happened here? Wow. Getting this on tape? Please work. No, that needs an electric. Okay. Hopefully that was just a problem with the mouse. Okay, here's the project. $100 million we pay out. We get $10 million in the first year. We get $160 million in the second year. What is the net present value? We're also given that the interest rate that's fair for this project is 10%. Okay. So we're going to use our formula, and the net present value is the present value of the costs with a minus sign on them. It's minus 100. And then we've got 10 million at the end of the first year. We discount back, divide by 1.1 to the power of 1. And then 160 divided by 1.1 to the power of 2. We get a positive NPV of 31.322. Okay? So this is a situation where this is a very good investment. Okay, so we're putting in 100 million. We're getting a great rate of return on this. 10 million the first year is not too much, but the second year, 160 million. So this makes sense to undertake this investment. All of the rules would suggest to go ahead. Okay? Yes?
How do you take the fair discount rate of the project?
We have to wait for that. I know I hate saying that, but suppose we're kind of there. Like, if I told you that the government bond interest rate for 2 years was 7%, then we know we'd have to use something above 7% that reflects the risk. Okay? And we'll get there. We're actually going to show you a formula and intuition behind that formula that tells you exactly how to get that 10%. Okay, or whatever rate. But for now, we know the base case is the government rate, and something's going to be added on to it because we know it's a risky project. What's going to be added on is going to be reflective of the risk. So more risk adds something extra. If you actually go to my country risk thing in my homepage, you actually see how I calculate discount rates for different countries. And U.S. examples have between like 10 and 15% discount rate. But for some other countries, it's rather eye-opening what you would use. And I'll show you actually how to do that. The net present value rule is kind of like something you should know almost immediately. If the project has positive net present value, take it because it enhances shareholder value. As negative, reject it. Kind of basic, but you've got to do it. And also, B, if you've got a group of projects that you can only choose one, they're mutually exclusive, then choose the one with the highest NPV. That's what you should do. And that's it for net present value. Now, it's much deeper than what I've pitched to you in like 5 minutes. And if you go to the project evaluation lecture note, you'll see all of the details. But what I want to concentrate on, I want to make the link to corporate finance. So when we're doing bond valuation, you can think of bond valuation in the same context as project evaluation for the corporation. But we're going to come back to the corporate finance angle later on and make this much more detailed. Yes?
When you're in that paragraph when you talked about if it's positive, it can be self-financed, that means you're banking on that positive result that you calculated and paid.
Yes, self-finance means that you can get somebody to give you the money to invest in the project.
Okay, counting on that coming at the end of the project too.
Yeah, because they can do the present value calculation. Like myself, maybe I don't have the expertise in this project, but I do have $100 million. Well, I wish. And I can loan it to somebody. They can invest in the project, and I'll get a rate of return on it. Go to the bank even. With a project like this, no problem. Easy financing. Wish we had projects like this. Go to the bank with a net present value of like $1 million. A $100 million project is going to be a little harder to sell. Because they'll say, well, have you done sensitivity analysis on the cash flows? So there might be a scenario where you actually lose. And depending upon how healthy your firm is, that could be an issue. So I've used the expected cash flows. I could do sensitivity analysis on these cash flows, but given the net present value is so large that it's probably unlikely that it's going to go negative. Well, what about bond price dynamics? And let's go to this, which looks kind of nasty, but it's not. This, I think, is the only instance in the course where we actually use some calculus. So what I want to do is to assess the sensitivity of the bond price, or the value of the project, to a change in the interest rate. The logical way to do that is with a derivative. So this is the formula for bond price right here, for the value of the project. present value equals the future value divided by 1 plus r to the power of t. And we need to assess the sensitivity to a change in the interest rate. This is a very easy one. It's like, if you recollect, y equals x squared, dy dx equals 2x, right? So drop the exponent by 1, multiply out front by the original exponent. That's all I've done here. The exponent is minus t. Take it out front and drop the exponent by 1. And this is not just gratuitous calculus. We're actually going to use this to develop a risk measure for bonds. That's going to be real important for us. If you recollect from last lecture that some of those curves, we're going to put the bond price against the interest rate doesn't have to move that much to drop the bond price dramatically for some of those bonds. So I need to know more than this bond's got 5 years to maturity or 10 years to maturity. I need to know personally what kind of hit I'm going to take if interest rates go up by 1%. And this is a way to quantify that hit. So it's a first attempt, too. So it tells us the change in the bond price with respect to a change in the interest rate. And it's negative.
What is the bracket underneath that second equation? Are you
Well,
just emphasizing that it's negative?
Yeah, it's supposed to be connected all the way across and it didn't actually work that way. But it's just to emphasize that this whole quantity is negative. Okay, because this is negative and the rest is positive. So it means if rates go up, the value goes down. If rates go down, the value goes up. Yes?
Doesn't that term indicate that regardless of the direction of interest rate change, the value will change by an equal amount? Meaning that the change in the current value of the bond will, be plus or minus X% given that interest rates go up or down 1/100%.
Yes.
But since our curves are nonlinear, aren't we finding the opposite in
Yes.
some of our examples?
So what is this doing? Like the derivative, go back to what it actually means. It's like the slope at one point. Okay, so the slope is like a line. But we know the curve, the bond price curve, is like this. So this is a very good approximation to the sensitivity for a very small change in the interest rate. But once there's a larger change, we're going to miss. And we're going to quantify the miss also. But it's good insight. So this is symmetric, whereas the bond price that actually occurs with a change in interest rate won't necessarily be symmetrical to positive and negatives. So what we're doing, what we're headed towards, and we're actually not going to develop this until next lecture, we're heading towards a measure that tells us something like the following. That if I invest this bond, in this bond, and interest rates go up by 1%, then I could stand to lose 20% of my initial investment, or 10%. So that's the type of risk measure that I have here. And that's why I'm doing this. It's going to be an approximation, but in many cases we can make sure that approximation is pretty high quality. We also do this in terms of the zero coupon bond.
Excuse me?
Yes.
Is the bracket the negative? What does that indicate on the
It just means the whole quantity is negative. Yeah. It didn't turn out that well. Maybe I'll try to redo that. But my graphics package had a connected line, nice bracket underneath, but when I gift it, it put these gaps in it. So maybe I should just get rid of the bracket. In the zero coupon bond, basically the same formula. Okay, so now the only difference here is that VT is just replaced with a 1. So let's say the bond's got a $1 future value. And take the change in the ZT with respect to a change in R and get basically the same thing. This is negative. So there's always a decrease. And let's actually try to navigate to this graph. This is the graph that we looked at last time. Can you remember this at the end of the lecture? Zero coupon bond. Notice that everything is going down in terms of as interest rates go up, the price goes down. It's very dramatic for the 30-year. Look at the slope here. It's just really huge. But for the 1 year, it's a lot flatter. I have reason to believe that there's an error in this graph. And I did not do this graph. But I supervised the project. Not very well, I guess. Take, just like a rule of thumb, let's take the 1 year bond. We can do that in our head almost. And let's say the interest rate is 10%. What should the price be of that bond? 91? And let's say the rate is 20%. What should the price be? It's a little more difficult to 82 or something like that. Yeah. So let's go up here, and this purple is the 1 year bond. At 10%, the price looks to me, I know it's a little hard to read, but it looks like 95 or something. And at 20%, it looks like 91. So I have reason to believe that these interest rates are like double what they should be. Okay? But it's no big deal. We're not going to be using this to price actual bonds. The shape that counts. Okay? And the shape should be real clear that there's an ordering here. It's a nice ordering. But the flattest one is the 1 year. And the steepest one is the 30 year. And notice the prices of these 30 years. The 30-year zeros gets really low at high interest rates. Which seems like, as I said last time, it seems like a deal. But beware, you have to wait 30 years to get your cash flow. And you might say, well, you know, I don't need to wait 30 years. I could just sell it, you know, next week. That's true also. And you might buy it for 75 cents and have to sell it next week for 30 cents. And if you have a lot, you know, $1 million invested here, you could lose almost all your capital very quickly. There's also the other side, right? 75 cents could go to, what, $7. The thing here is that this bond is very, very risky. That's why I said I wanted to develop a measure of the risk of these bonds. And I think it's pretty clear that the 1 year is not that sensitive to a change in the interest rate. But as we go to higher and higher maturities, you know, we're going to get a lot of sensitivity. So the 30-year zero at current interest rates, if rates go up by 1%, you lose more than 25% of your capital. 1% move in rates is not that substantial of a move. Well, it's a substantial move, but it's a move that we've seen easily over the last couple of years. Yes?
Over the course of 30 years, won't interest rates sort of stabilize out amongst the changes? Like if this year it's 5%, next year it's 8%, the following year it's 12%. I mean, over that long of a period of time, are you as concerned with the changes in interest rate?
So if you're holding the bond to maturity,
Right.
That's what you're saying. That's a good point. If we hold to maturity, let's say we bought the bond and it's yielding 7%. If we hold it to maturity, what is the yield that we're going to get? 7%. So if we can stay in the market for 30 years or put this bond away, we're going to get 7%. Totally agree. But sometimes you need the money and you have to liquidate the bond. And that's where you can get into trouble. Yes?
Is there any evidence that, as hopefully all economic models that everyone's spent so much time developing over the last 30, 50 years, that is gradually, very slowly improving our ability to predict economic cycle is a little bit better than 30, 40 years ago, that all these slopes are slowly evolving to a flatter shape. Not that you would trade on that assumption, but just that slowly, as the fluctuation of interest rates become less severe as they were in the past, because hopefully inventories don't build up as badly as they used to.
Okay, okay. It's like multiple statements that you're making. And one has to do with the question, is the business cycle less volatile today than it was like 15 years ago? And that's real hard to measure. And the problem is that there's just not enough data to measure it. And maybe this most recent episode where we were like close to a recession last year, and it seemed like we avoided it, could be interpreted as evidence that we are in a less volatile business cycle. But I would be hard pressed to draw inference based upon a couple of years of observations. If you actually look at the whole history of the business cycle, it's not real clear there's any change in the volatility. Volatility just meaning the maximum up and the maximum down. As for the interest rates, there's definitely a change in volatility if you look at 1979 to 1981 compared to where we are now. Because if you recollect, well, from your macro course, you've done that yet?
No.
Right now. Well, the Fed did an experiment, and interest rates went all over the place. You probably know that already. Short-term rate went to 21%. And then it was down, and it was up. Huge volatility. But that was a pretty isolated period. And if you look at rates after that and rates before that, not that much evidence that things are less volatile than they look like. Like 2 years ago, the difference between the short-term interest rate was like 2.9%. Today it's, what is it? 5.5? So it's not clear, and it's also not clear that the economic models that you're talking about, for example, Lucas, who won the Nobel Prize in economics for business cycle models, who was, I guess, a student in Chicago, and his models explained what was happening in the business cycle. Didn't predict. It's unusual to find prediction models. We'll talk about one prediction model, and that is under the term structure of interest rates. There's a link to my dissertation paper. And that is basically a model of predicting the business cycle. It's a little different than the usual approach. But we'll talk about that probably at the beginning of next lecture. So it's a question I could talk about all day, obviously, especially if I get sidetracked into my thesis. You don't want to. Okay, well let's look at an example. And this example and what follows is actually, you should make sure you're checking the bulletin board. There's some good exchanges already on the bulletin board. Okay? And sometimes, if somebody posts a question and then there's like 3 answers that are the correct answer, then I'm not going to go and post. Just assume that you figure out the 3 outweigh the 1. If it's the case that the 3 are all wrong, then I'll definitely jump in. I monitor everything. Okay, but be sure, to do that. Also, I've been posting emails to me. Okay, I warned you last lecture. If you email me, then there's a likelihood that I will post it. And I've done that also. Okay, so the question's emailed to me. I'll just copy it and post it, and then provide the answers. Okay. But this example here is something that led to an exchange. This is a situation where we've got coupon paying bond, 12% coupon, annual coupon. So there's no semi-annual here to make it simple. And we're going to evaluate the price, or the present value of the bond, in 2 interest rate scenarios. The first one is 12%, and the second one is 13%. So before we do the calculation, I will scroll down, you can see it on your lecture note, but before you do the calculation, it's generally good to think about the problem. So if the going rate of interest is 12%, and I've got a 5-year bond that is offering to pay me 12%, how much am I going to pay for this bond? $100 par. I wouldn't pay less, I wouldn't pay more. Well, I wouldn't pay more. If I could pay less, that'd be great. But it's probably not going to be available at less. And what about the 13% interest rate? The going rate is 13. Less. Somebody tries to sell it for par. There's going to be no takers. So the price has got to be dropped. So before I even begin to do this, and for the first calculation, I would hope that you wouldn't have to go through the exercise of discounting the cash flows. You just say it's $100. The second one you actually have to do. But if you go through the calculations and find that it's worth like $105, you should trust your economic judgment rather than the numbers that you worked at. Because the 13% at $105 has got to be wrong. This bond at 13%, coupon's only 12, the going rate is 13, must be worth less than $100. So in an exam situation, just say, well, there's some calculator error somewhere. Move on. Okay? Because the important thing is not you punching the numbers on the calculator, but that you understand the basic concept. And the basic concept is that the 13% interest rate scenario is going to put this bond less than $100. It's exactly what occurs. So I proved to you that the bond price at 12% going rate is 100, at the 13% rate is 96.52. I use the same sort of intuition with the zero coupon bonds. So the price of 12% zero coupon bonds is 0.893. Multiply that by 12 and I get 1071. This price of the zero coupon bond is sometimes called a discount factor. Call it what you want, doesn't make any difference. You get it to $100. So if the interest rate goes up, the price of this bond is actually going to go down. Now, the next example is an example of holding period return. And the question here suggests that, well, suppose that I bought last year a 6-year bond. Bond had 6 years to maturity. And the coupon was 12. And the going rate of interest is also 12%. We don't need a table. The table only did the 5-year bond. But we don't need the table to know that that bond's going to be worth $100. And suppose we hold the bond for a year, and then at the end of the year, we collect the $12 coupon, and we sell the bond, but the interest rate is dropped, or is increased from 12 to 13. We do this calculation because we already know what the price is at 13. So a 5-year bond with a 12% coupon rate, 13% interest rate, the value of that bond is $96.52. And we already worked that out. So let's go through and calculate our holding period return. And this is where there's a good exchange in the news group. So let's look at the numerator. We get $12, that's a positive. It's cash coming in. We sell the bond for $96.52. That's a positive, that's a cash coming in. And the negative is what we paid for the bond originally, and that's 100. Divide by what you originally paid for, which is 100. Don't divide by 96.52. That doesn't make any sense. I don't know what that means. Always start, you calculate the rate of return based upon what you initially invested. And it turns out in this case, the holding period return is 8.53%. So we bought this bond with a 12% coupon for 100. We made the coupon, but we took a capital loss on the value of the bond. And it turns out the holding period return is 8.53. And there was some discussion in the news group about, well, what happens if it's longer than a 1-year holding period of return? Well, we could use basically the same formula. Suppose that I bought this bond, it's a 6-year bond, 12%, paid 100, held it for 2 years. Well, then I'd have 2 coupons, right? And suppose the same scenario, the rate drops or increases to 13. It's not 96.52 anymore. We have to redo the calculation for a 4-year bond with 12% coupon, 13% interest rate. And we can calculate the holding period of return. And it turns out that there's not, I won't talk much about these longer period, holding period returns, because there is a kind of a subtle issue. And that is, what do you do with the $12 you got at the end of the first year? We certainly don't take the $12 and put it in the mattress. So it'd be some reinvestment. So that kind of complicates things. So almost always it's simple, like you get the coupon at the end of the period, or in the assignment, it's like instantaneously the interest rates change and you calculate what happens. Okay. So that's the holding period return. And actually in the bulletin board there's a general formula for holding period return, which used to be in my lecture notes. And this is the first year that I pulled it out. Because I always found that it was a source of confusion. But I guess I got to put it back in because a number of people requested the general formula. But you should be able to figure it out. It's basically what you get is positive, and what you paid is a negative, divided by what you paid. Kind of a general formula in itself. Okay, next, annuity valuation. It's the next step in valuing a bond. Basically, I don't want to go through the brute force method that we did for that bond, where I put all the cash flows down, figured out how many zeros I needed, prices of the zeros, and then added it all up. I don't want to do that. I want a general formula. And it turns out that the previous example was like 5 cash flows. Well, what if it's a mortgage that's got 30 years? Well, 360K. So I need to develop a general bond pricing formula. We're going to start out with this idea of an annuity. A simple example is like a mortgage. An annuity is a constant or identical payment every period, like a mortgage. So there's a monthly payment, and my example here, $70,000 mortgage, if the mortgage rate's 14%, stated rate, the effective interest rate is 1.166%, and this is a 15-year mortgage, so 180 monthly payments, and the monthly payment is $932.22. So the annuity payment is $932.22. So this is useful because we could use what we're about to do to figure out what the payment on a mortgage should be at a given level of interest rate. We can use the same formula to value a series of annuity payments. And finally, we're going to use this formula to value coupon-bearing bonds. So let's introduce some notation. M is going to be the number of times interest compounds each year. In this case, 12. K is the number of years in the annuity. In this case, 15. N is the total number of compounding periods. In this case, 180. R is the APR. In this case, 14%. And A sub N is going to be the present value of an N period $1 annuity. So it's the present value of $1 every month for 180 months. Okay, that's what that stands for. So the first thing we're going to do is to calculate the value of this $1 annuity. And we can do the one month ahead. It's pretty simple. It's just a 1 month zero coupon bond at a rate of 1 plus R is 0.14 divided by 12. R divided by M. And the zero coupon bond for the second period is just going to be 1 divided by 1 plus R divided by M to the power of 2. Right? And that's the same thing as Z squared. And for the third period, it's the same story. It's 1 divided by 1 plus R divided by M to the power of 3, which is identical to Z cubed. So the present value of the annuity is just Z plus Z squared plus Z cubed plus dot 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 all the way out to Z to the n, in our case Z to the 180. So we need to add that up, and I guess we could, as I say, do the brute force addition, or we could use this trick, and let me, I always forgot this formula, so in the lecture notes I actually wrote it out. It's the sum of the geometric series. Basically we have like x plus x squared plus x cubed all the way to x to the 180. How do we get a simple way of summing that geometric series? It's a finite geometric series. Take the value of the annuity, multiply both sides by z, and then subtract. Subtract this and this. When we do this, there's a lot of common terms that drop. The z squared, the z cubed, even the zn drops. So we get an 1 minus z equals z minus z to the n plus 1. Divide both sides by 1 minus z, and we get the formula for the present value of an annuity. N period annuity, so z times 1 minus z to the n divided by 1 minus z. It's the formula you should remember. But note that both exams, you can bring in a sheet of paper. There's no need to memorize formulas in this course. This is a useful formula. And if your annuity is not $1, but $932, just take this and multiply by little a, which is the actual size of the annuity, and you get the present value of this larger annuity. So this formula, this a to the n, tells us the value of a $1 annuity for, let's say, 180 months. And this one down here, when I multiply by the little a, tells me the value of an arbitrary annuity for basically arbitrary interest rate, arbitrary time to maturity. We can also write this, if you don't like to do this in terms of the z's, and I do, because it kind of preserves the intuition of where present value is coming from. We can always just make the substitution and do this in terms of the interest rate. So we know that z equals 1 divided by 1 plus I. So all I've done down here is made the substitution of the definition of z. And what we get is just an alternative way to write the annuity formula. It's equivalent. It makes no difference whether you work in z or I. You get exactly the same answer. One thing that might be useful is to note that as the number of periods goes to infinity, so up here, as n goes to infinity, this term basically goes away. It gets very small. And we get the present value of an infinite annuity. And this infinite annuity is sometimes called a console. These are actually traded, where you're promised a coupon of a certain amount forever. And the way to get the present value of that is simply to take the coupon and divide it by the interest rate. So if it's an annual coupon of, let's say, $100, the going rate of interest is 10%. Then it's 100 divided by 0.1 equals 1,000. So that's a simple way to get the value of a console. Well, let's go back to this example with the mortgage. $70,000 mortgage, 15 years, 14% interest rate, monthly, so it's 1.167. What I want to do is to show you where that 932 came from. Okay, so let's use the formula. The annuity value is little a times z times 1 minus z to the n divided by 1 minus z. And we know what a to the n is. It's $70,000. We know what the z is. We know what n is. The only thing that we don't know is the little a. So, given that situation, I'll figure out what z is. I'll figure out what the annuity value is. And I get 70,000 equals little a times 75.09. What's the interpretation of 75.09? What does that mean? Present value of a $1 annuity for 180 periods. Okay. But it's not $1, it's $8. So divide both sides by 75.09 and you get 932.21. So what we've done is we've valued, in a way, a mortgage. We've also, given the value of the mortgage, figured out what the monthly payment is. So it's just a basic annuity mechanics. Okay, the other concept, there's a bunch of concepts that you need to know before we actually go forward in this bond valuation. The other is a word that you probably heard of, and maybe you've seen one of these for a loan. It's the idea of an amortization schedule. So suppose we borrow $1,000, and we're going to pay the loan back in 5 equal payments. And each payment will contain interest and principal, just like a mortgage. Except this is a shorter term loan, and it's only annual payments. So let's compute these equal annual payments using the annuity formula. So Z, given the interest rate is 10%, it's going to be 0.9091 into our annuity formula, and we get the annuity factor equal 3.791. Interpretation, this is the present value of $1 paid at the end of each year for 5 years. The present value is 3.791. We know the value of the loan is $1,000. Divide both sides by 3.791, and we get $263.80. So that's the payment on this loan, $263.80. And now what I want to do is to go through how it's actually paid off. So we start with $1,000. We know the interest rate is 10%. We also know the payment is $263.80. So given we're paying $263.80 and the interest is only $100, we must be paying down principal, and we're paying down $163.80. The ending balance in terms of principal is $836.20. So effectively, we're bringing that much principal into the second year. The interest on that is $83.62. Again, we're paying the same amount, $263.80. Therefore, we're paying even more principal down, $180.18. And you can trace through this all the way to the end until we end up with 0. So the point here is that with a loan that pays back, depending on what side you're on or you're paying, you take the loan out. An annuity type payment. That payment contains both interest and principal. And it's almost always the case that the principal part becomes more important as the loan becomes closer and closer to becoming due. Like a mortgage, do this calculation for a 30-year mortgage. You'll find that the very first payments, basically all interest. Very little principal is being paid down. And it's much more dramatic. This is a 5-year loan, and you're paying actually a fair bit of principal down in the first year, 16%. now what I want to do is introduce some more notation. We're going to have a coupon bond. And the coupons are going to be semi-annual. So it'll be like a stated coupon rate, which will be capital C. And there's going to be a semi-annual payment of that. You should also note that there's a lot of conventions in the bond market. For example, if you looked in the Wall Street Journal under bonds, you'll notice that they're quoted in 30 seconds. So 102-8 is $102.08, which is like a quarter. All right? There's many, many conventions in the bond market you have to be aware of. Yes?
Does the dollar signs on either side of the C have significance?
Yeah, the significance is that in my old word processing package, that turned that C into an italic character. And I got that on my list already to fix. So there's no significance other than the typo. Things like the banker's discount rate. I think that might be on the assignment. Is there a question that deals with that on the assignment? I forget if I give the definition of it. You don't think so? It might be in the glossary. But roughly speaking, if you're told that the discount rate is 10%, let's say you've got a 1-year zero coupon bond, that implies a price of $90. So the way they calculate it is 10% discount from par. 10% of par at 100 is $10. Therefore, the price is 90. Now we know that the discount rate is not the rate of return. So if I buy this bond for $90 and hold it for 1 year, what's the rate of return? 11. It's 11.1%. Right? Buy it for 90, sell it at 100. 11, a little more than 11%. So the discount rate is going to underestimate the actual rate of return.
Are you talking about the banker's discount?
Yes. Okay, the so-called banker's discount rate. Now, the other thing is that, and I said basically, and I already meant basically, because the banker's discount rate is calculated on the basis of a year that's got 360 days. Which is a very strange convention I never really understood, because everybody knows that there's 365 days in a year, with certain exceptions every 4 years. So you have to be real careful, especially if you're doing some transactions, of all these conventions in the bond market. And what I recommend to students is that they purchase a book, and I forget the exact title of it, it's called something like Money Markets. And the author is Marcia Stigum, S-T-I-G-U-M. And this is a very thick book filled with conventions in the bond market and money market. It's a very good investment because if you make a mistake on one of these conventions, it could be very costly. And she goes through all of these subtleties and all of the formulas that are relevant. And it's quite a good book. I believe it's used in the money and capital markets course. If you want to take that, if you don't want to take that course, I give the book. Much more is done in the course than the book. But the book is very good in terms of setting out some of these bond conventions. Okay, well, let's continue with the bond valuation. And what I want to do is to look at the 4-year, 8% Treasury bond or Treasury note. Note usually just means a shorter maturity Treasury bond. The convention is to call it a note. So let's do a timeline with the coupon and the principal. The coupon is $4 every 6 months. And this is 48 months, didn't quite fit on the screen. There it is. So it's $4 every 6 months. And the principal, 100 at the end. So basically, this is what we're going to do. We're going to take the coupons and treat them as an annuity, and use the annuity formula for the coupons. We'll take the principal and treat that as a zero coupon bond. We already have the formula for that. We're going to put the two things together, and that's going to equal the bond price. So that's basically the technique that we're going to use to do the valuation. And this is notation, but most of this notation is just a repetition. So capital C is the annual coupon rate. M, which is new, is the number of coupon payments per year. In most cases, 2. And little c is the periodic coupon rate, which is cap C divided by M. So the formula for the bond price, the general formula for the bond price, is going to be the value of the coupon annuity, which is going to be little c times the annuity factor, plus 100, which is the par value of the bond, times the price of the zero coupon bond that pays $1 in n periods. Put those two together, and you get the value of the coupon-bearing bond. Yes?
You always use a hundred C to the end?
If I'm quoting the bond in terms of $100, yes.
What if nothing is mentioned? For example, in the second column, the supplement uses 1,000, but there's no mention of 1,000 anywhere. The question, what assumption should you make about this?
You can assume whatever you want. Okay, you want to make 10,000, 100,000, I don't care. $1 million. Okay. What I don't want to see is if I tell you the coupon's $40 every 6 months, and you tell me that the face value is 100, that's kind of hard to believe. Okay? But it doesn't really matter. The convention is 100, but sometimes I do $1, sometimes I do 1,000. It doesn't really matter. So we could develop the bond price in terms of 100, and if you tell me there's $100 million, then it's simple to put 6 zeros on it. Or get the number of zeros correct. But this is basically what we're going to do. And let's go through some examples. So suppose that the current interest rate is 12.5%. And I'm going to value 2 bonds. Both have 12 years to maturity. One bond has a coupon rate of 8.75%. And the other bond has a coupon rate of 12.625%. We're going to use this formula to find out the value of both these bonds. As we did before, let's think about these bonds. The interest rate is 12.5. One bond is real close to 12.5. Bond B. So bond B should be worth more or less than $100. Okay. Now bond A, that's way less than 12.5. So this can be worth much less than 100. Right? Okay, well, now let's actually do the calculation, given we know that. So first thing, figure out what the Z is. And that's 0.941176. Z to the 24, which is the zero coupon bond with 24 periods or 12 years. That's 0.2334. And finally, the annuity factor, or the present value of a $1 annuity. This is going to be Z times 1 minus Z to the power of N divided by 1 minus Z. And that equals 12.2655. Finally, the simplest part of the calculation is to figure out what the semi-annual coupons are. Just take the annual coupon rate divided by 2. And now we're actually ready to use the bond valuation formula. And let's take a look at this. Notice first that there's a lot of similarities between the valuation formula for A and for B. For example, the final payment is identical for both. $100. This part is identical. Notice the annuity factor is identical. 12.2655. Really, the only difference here is the coupon rate. In the first bond, when we take the value, it's $77. The second bond that is paying a coupon slightly above the going rate is $177. Which kind of squares with our initial intuition, and it's real important not to make the following mistake, which I see a lot, unfortunately. If people go through the calculation using a different interest rate for these two bonds. In fact, what they do is they use the interest rate of a little more than 12.5% for the first bond, or the second bond, and the coupon rate for the other bond. Don't use the coupon rate as the going interest rate. That doesn't make any sense. What happens when you do that? You always get par. Not that interesting. But you know that's wrong, right? Because does it make sense for the bond that's paying like an 8.75% coupon in a 12.5% interest rate environment to be trading at 100? It makes no sense. Okay, so there's only one situation where you use the coupon rate as a rate for discounting. Only one situation. That's a situation where the bond is trading at par. That's a situation where you wouldn't even use it anyways, because you know the bond price is 100. Okay? So this is a way, so this is going to be the formula that we use for annuity valuation. Okay, well let's, maybe this is a good point to take a break. All day, go to Syllabus at night, and eat some bad food. So let's get started again. What I want to do in the second half is talk about yield to maturity, and has to do with yield to maturity. And actually, this is one of the questions on assignment number 1. It's related to yield to maturity. The problem is, let's calculate the rate of return that we're going to get on a coupon-bearing bond. We've already figured out how to get the rate of return for a zero coupon bond. So for example, if I told you the bond price is $90 and it's got 1 year to go, it's a zero coupon bond, what is the rate of return I'm going to get after 1 year? 11.1. So the way to get that is to take the final price, 100, divided by the current price. And then there's an issue of what exponent to take that to. If it's 1 year, then the exponent is just 1. It turns out that it's more complicated to do this with a coupon-bearing bond. Because this is the formula for the bond price for a coupon-bearing bond. And notice this formula is a little more general than the sum of the annuity and the zero coupon bond. It's more general because notice the coupon, I've got a subscript level, T. So I'm allowing for the possibility that the coupon changes through time. So it might be $4, it might be $5, it might switch. So this is the general bond price formula with no shortcuts. So the idea of yield to maturity, or the internal rate of return, is what is the single interest rate that makes the present value of the right-hand side exactly equal to the present value that's implied by the price. And so it's like you observe a market price. You know what the cash flows are. Even if the coupon is changing through time, we assume that we know how it's changing. What is the interest rate whereby the right-hand side exactly equals the left-hand side? That's the idea of internal rate of return. Now, with the zero coupon bond, that was easy to solve for. I gave you the formula for it. I think it was like R equals VT divided by V0 to the power of 1 divided by T minus 1, something like that. I could solve for the R. Here, it's not so simple to solve for the R. And the reason is that this interest rate shows up in many different spots with many different powers associated with it. So mathematically, we actually cannot solve for the interest rate. Best that we can do is to approximate it. And here, if you have a financial calculator, it's probably got an IRR function. In Excel, there's an IRR function. And they use approximations, good approximations, to get this number. Now, it turns out the internal rate of return is simple to calculate in a couple of special cases. One of which is, suppose I've got a coupon-bearing bond, the coupon's 8%, the fair rate of interest is 8%. What is the internal rate of return? 8%. The price of the bond is 100. So in special situations where the fair rate of interest is the coupon, or the bond is at par, then it's simple to get the internal rate of return. Most situations, we're not going to be exactly there. So what we could do is kind of by brute force, try different interest rates to try to get the right-hand side equal the left-hand side. Or we could use the internal rate of return function in Excel or our calculator. Now, I actually suggest that, and I think it's pretty explicit in one of the problems in assignment number 1, that you actually try a few numbers just to convince yourself that you can set up this, this function. Okay, and to see what happens when you try different interest rates. And all that's going on is the same sort of thing your approximation routine is doing in Excel, except you're doing it manually. And don't be concerned that your calculator doesn't do IRR and somebody else's does for the midterm exam or the final exam. This is extremely unlikely. I would ask a question where like half the class could hit a button and get the answer. The other class would have to work this out by approximation methods. It doesn't make any sense. I would not. Well, it could make some sense for some professors, but not for me. Okay. So I guess it could be a way to get you to buy a financial calculator. Okay, well this is the formula, and one thing that I want to emphasize is people don't usually transact in bonds based upon the internal rate of return, the yield to maturity. There's other things that we worry about. So just the yield to maturity is not sufficient information for me to actually trade a bond. And let me be a little more explicit. It sounds confusing. Let me try to explore this in some detail. I've got an example of two bonds, bond A and bond B. Both are $1,000 bonds. And they have much different styles of cash flows. The first one is a 14.5% coupon that's paid annually. And the second one is an annuity style bond, where there's no principal at the end. It's just $430 every year. And both have a price of $1,000. And it turns out that for bond A, it's real easy to get the internal rate of return because it's a special case. You need not go through the calculations because it's exactly 14.5%. The second bond is an annuity bond, and actually, because it's a special annuity bond, it's fairly easy to get the interest rate on this one. And it turns out to be 13.9%. So we're looking at these bonds, and one is yielding 14.5, and the other is yielding 13.9. It seems like bond A, well, more than it seems, it's got a higher internal rate of return. So bond A might appear to be more attractive to you. Well, we have to be careful. And let me go through an example of how this could potentially break down. One really important thing in calculating the internal rate of return is you're basically taking the market price as the true price. What actually, a better way to approach this problem is, okay, here are the cash flows. Let me identify the interest rates that are relevant for these cash flows. And let's take the present value of the cash flows and compare that to the actual price of the bond. Right? So that's what I'm going to do. And it turns out that I'm going to use very particular interest rates. In the first year, the interest rate is 10%. The second year is 20%. And the third year is 15%. Suppose that was the exact structure of interest rates.
That's what we think they're really going to be?
No, I'm just giving you these as the interest rates. Okay. If you knew these interest rates were exactly 10, 20, and 15. We could also do this with an expectation of the interest rates. But suppose that, that these are just given. Okay? Because there's no uncertainty in this problem. So let's take the present value of the cash flows for bond A. The first 145 is discounted by 1.1. If we had identical interest rates for the whole structure, then the second cash flow would be divided by 1.1 to the power of 2. And the third one would be 1145 to the power of 1.1 to the power of 3. We've got different interest rates, we're going to use them. So the rate in the second year is 20%. So it's 1.1 times 1.2. The rate in the third year is 15%. It's 1.1 times 1.2 times 1.15. This delivers a present value of 996. Do the same exercise for bond B. Notice the denominator is identical in all cases. The only difference is the numerator. And it turns out that bond B has got a value of $1,000. So bond B, the value that we calculate, given the interest rates, is exactly $1,000, which is exactly the price the bond is being sold in the market. Bond A, we actually calculate a price that's lower than the price in the market. So this actually might change your view of the attractiveness of bond A. Because given the interest rates, this bond is overpriced. And it doesn't necessarily make sense to buy this bond at $1,000 when the true value of the bond is $996. Okay, so the lesson here, and it's an important lesson, though it might seem like a kind of a constructed example. The lesson is that we always take the present value of the cash flows and make an investment decision based upon a present value of all the cash flows. The summary number, internal rate of return, is that. It's a summary number. It's based upon the price of the bond in the market. It takes that price of the bond in the market as the true price. So we always want to look at the present value of the cash flows. I'm not saying not to look at the internal rate of return, because everybody does. But you've got to look beyond the internal rate of return sometimes. In this particular example, it might lead you to overpaying for a particular bond. Yes?
If you assume no arbitrage, as you did in the previous examples, then the IRR would be a very good measure because the value of the price would be exactly the value. But sort of for this example, you're assuming there's arbitrage opportunity.
Yeah, well, what I'm assuming is that one of the bonds is mispriced in the market. Right? And what I'm suggesting to you is that if you're just looking at internal rate of return, there's no way ever to detect a mispricing. Because you never actually try to calculate the price. Just like you're finding an interest rate given the market price that makes the discounted value of the cash flows equal to the market price. And who knows what that market price is, if it's too high or too low. The internal rate of return is sometimes used because it could be that you've got two bonds that look very similar, and one has got a way higher internal rate of return, and people look at that and say, well, that's evidence that potentially this bond is priced incorrectly. And so you've got like a couple of bonds very close in maturity, very close in coupon, but one internal rate of return is much higher than the other. It's possible it's because of a fundamental mispricing. Then you would go through this same sort of exercise to identify what the true price should be.
So someone might use IRR to look for arbitrage.
Exactly. As a filter. But the actual execution of the trade would be based upon present value of the cash flows. Okay. Make sense? In general, it's hard to find these arbitrage opportunities for bonds that are fairly liquid, but for corporate bonds or bonds that are so-called, off the run, that are not talked about or traded that much, there are possibilities, and people make a living doing this. Just doing arbitrage. Okay, so it's a lesson actually that we will return to when we do project evaluation. Because a lot of corporations make the mistake of simply evaluating a project in terms of the internal rate of return. So this doesn't have to be like a bond. This is very general, what I've talked about. These are just cash flows. It could be cash flows from a project. The cash flows, the CT, could be negative, could be positive. It could, the C1 could include a large investment, which would be a negative number. The final value, which I say is 100, well, not necessarily 100. It could be the salvage value of the project. And all of this works for corporate finance as well as investment. And sometimes corporations make the mistake of simply viewing the internal rate of return of projects and not looking at the present value. And there's some like really dramatic slips that you can make. Like, for example, the internal rate of return says nothing about the scale of the project. You might have a great internal rate of return, but if you're limited, if your capital is constrained, this project might be, a very small portion of the available capital. So you always want to look at the size of the project. So it might have a lower internal rate of return, but it's a bigger project. And it will create more net present value for the firm. So there's a lot of things that could happen with internal rate of return that you want to avoid. As I say, the project evaluation lecture goes through a lot of these details. But for bonds, you'll notice in the paper that we get the yield to maturity quoted alongside most of the bonds. It's a useful number, don't get me wrong, just that we have to be careful. So this is just documenting the internal rate of return on A and B, the present value, 996 and 1,000. I also calculated the future value. And it actually doesn't matter if you work in future value or present value, you get the same story here. That one is worth less than the other. As long as you're standing at one point in time that's consistent, future value, present value is going to give you the same answer. Let's consider another example. And again, it's a constructed example where we've got bond A and bond B. Bond A is going to be an annuity bond this time. And it's going to have $263.80 every year. That's the payment. So it kind of combines coupon and principal. There's no payment at the end. And bond B is going to be a zero coupon bond. And it pays $16.1151 in year 5. And what I want to do is I want to evaluate these bonds at different interest rates. So let's do that. So I want to take the present value of these bonds in different interest rates scenarios. And the easiest to do is the zero scenario. And there all you do is just add up the cash flows. That's the only situation that, the most critical error that you can make in this course. The error that shows me that you misunderstand the most rudimentary things in this course is to take cash flows through time and just add them up and tell me that's the value. Okay, because cash today is different than cash in 20 years. And to add it all together doesn't make any sense. We never do that other than one trivial case. And it's really trivial because the interest rate has to be zero for it to work. Okay, so in the zero scenario, we just add up the cash flows, and it turns out that B has got a higher value than A. So in the last category, the better category, it suggests that B is better. At 5%, the difference between these bonds shrinks, and B is still better in terms of value. And at 10%, magically, both of these bonds have exactly the same value. And that's, of course, how I constructed it to happen. So both A and B have $1,000 values, and you're indifferent. And as soon as the interest rate goes beyond 10%, notice that B becomes less attractive than A. So depending upon the interest rate scenario, you've got a real clear preference over these bonds. B is better with lower interest rates, and A is better with higher interest rates. And I attempted to graph this. So let's take a look here. So this bond is B, and this is the zero coupon bond, and A is in green. Notice that this is where we said that we preferred B to A, and this is where we prefer A to B. Both have 5 years to maturity, but the characteristics of these bonds are much different. And one thing that we should notice immediately is the slope. Just like that graph that I gave you at the very beginning with the different zero coupons. This is different. This is a graph of one is a zero coupon and one is a very high coupon. Notice that we crossed at 10%, but the slope is much different for these two bonds. Okay. That slope is measured by the derivative that we did earlier, and we're going to actually translate that derivative into a measure of bond risk. But this is, I think, an interesting example because it shows you how moving the cash flows. So one extreme is the same cash flow every single year. The other extreme is putting all of the cash at the end. Moving the cash flows across time dramatically changes the shape of this bond function. So tell me why the pink line is steeply sloped. What's the economic intuition? What's the mathematical intuition? Yes?
It's steeply sloped because as the interest rate is higher, the cost of not getting your cash flow in the early years is higher as well. So as interest rates are higher, the fact that you didn't have any cash flow at year one hurts more.
Okay, that's true. That's true. That's an economic explanation. Yes?
Well, your bond B, we're talking about bond B, right?
Bond B.
Bond B is wholly dependent on the last payment.
Yes.
So as the rate rises, that last payment, the value of that last payment goes down. Where bond A, it has payments spread out over 5 periods, so it kind of hedges. I don't know if that's the appropriate way to. Well, it
Hedges across time.
perhaps.
Yeah. So what if the rates move for all maturities the same way?
I beg your pardon.
The interest rate that's relevant for 1 year, or 2 year, or 3 or 4 or 5 changes exactly the same proportion. Isn't the effect on why is the effect on the 1 year any different than the effect on the 5 year?
Well, because it's not discounted to the proportion of the power of the year. So
Power. That's the
so
power.
you
So
have-
the power is 5.
right.
For
So
that last
it's
calculation.
magnituded by power. It's magnified by power 5.
Exactly. So it's like economic intuition, there's kind of like mathematical intuition. Then for the zero coupon bond, we got this last cash flow discounted by like 1 plus R to the power of 5. So it's geometrically increasing. Whereas the other bond, it's got something that's discounted by 1 plus R, and something else, 1 plus R squared, 1 plus R cubed, and it's only a smaller proportion, $263, that's discounted by this 1 plus R to the power of 5. So just because of the mathematics of the situation and the fact that something to the power of 5 is going to really explode the impact of a change in the interest rates, there's going to be a much different pattern in sensitivity of this bond price to a change in the interest rate. Yes?
In the notes, we're looking at the graph and we conclude that bond B has a greater duration, and that's purely because of the slope, the magnitude. It's totally relevant, the fact that they're cross.
Yeah, so next lecture we'll talk about duration and modified duration and things like that. And that is a measure of the sensitivity of the bond price to a change in the interest rate. Okay? And just like the derivative is a measure of the sensitivity. And it's real clear looking at that pink graph, the pink curve, that is more sensitivity to a change in the interest rate than the green one. The slope is a lot steeper. It's all the way through. So yeah, we would conclude that. So in terms of what we've got so far, we conclude that bond B has more sensitivity to a change in the interest rate than bond A. And the reason is the timing of the cash flows.
Is that just a vocabulary? Is sensitivity and volatility, can you use those interchangeably?
Yes, but we'll almost always talk about sensitivity. It is true that a more sensitive bond will be more volatile. But volatility is different than sensitivity. Let me explain. The sensitivity is very particular. It says for like a 1% change in the interest rate, what is the predicted percentage move or absolute move in the bond price? Okay. Whereas the bond volatility is going to be a measure of how much fluctuation there is in the bond price. Like during the year, it might go from 90, 80, up to 110. It's a measure of how the returns change during the year. It's directly linked to the sensitivity, but it's a different measure.
Volatility is price, and sensitivity is?
Sensitivity answers the question, what is the predicted change in the bond price for a 1% move in interest rates? Okay. Volatility doesn't tell us that. Volatility is some measure of the dispersion of the bond price over a year, let's say. The expected dispersion. Okay, so that's different. Yes.
So in terms of sensitivity, we can think of it as more like elasticity.
exactly elasticity. But it's slightly different than the usual terminology of elasticity. Like when you do micro, it's the elasticity is the percentage change in something divided by the percentage change in something else. And often what we do is summarize the whole course. So what we usually do is to look at like the absolute, like the dollar change in the bond divided by the percent, or well, actually the percentage change in the bond divided by the change in the interest rate. Okay, so rather than the percentage change in the interest rate. Yeah, so the numerator would be the percentage change in the bond price divided by the absolute change in the interest rate. So when we go like 7 to 8%, that's like 1. That moves 1. Okay. So that's it's a little different, but it is very much related to elasticity. We will talk about elasticity later on. Okay. Forward interest rates. This is kind of the last thing that we need to know before we do modified duration and hedging and stuff like that. And traditionally, I found that this is a difficult concept to communicate. So I'll warn you right off. So let's spend some time, because I think well, it's hard for me to judge as the guy sitting up here how difficult something is sometimes. But I think this is pretty easy. It's just a problem with me communicating it. So let me give it a whirl. So this is the way I think we should look at forward interest rates. And we've got 2 investment opportunities. And let's think of investing in like a certificate of deposit at the bank. And you know that they offer many different maturities for a CD. So the very first strategy that I've got up here is a strategy of buying the 2-year CD. And let's say it just pays interest once a year. And they quote some annual rate. And the return on this strategy is going to be the annual rate plus 1 squared. Right? And that's what that notation is. 0R2 means it's the 2-year CD rate available at time 0, which is today. So that's a return on that strategy. The second possibility is I invest in a 1-year CD, and then at the end of 1 year, roll over into another 1-year CD. That's a possible investment strategy. And this formula that I've got up here, what it says is, here's the return on the 2-year strategy on the left-hand side. On the right-hand side is the return of investing in the 1-year CD, and the forward rate between 1 and 2 is defined as the rate that makes the returns on these 2 strategies exactly equal. Okay, so let me rephrase it. I'll try to rephrase it 5 times. It's the reinvestment rate that would make you indifferent between rolling the 1 year into another 1 year or holding the 2 year. It's the rate that you need to get in the rollover to exactly achieve the 2-year buy and hold purchase, the 2-year CD. So the way to get it is this formula, which is, I think, a real simple formula. This is the rate for the 1-year CD, and 1F2 is this forward rate that you would need to get for 1 year, beginning at the end of the first year, to exactly make you indifferent between these 2 investment possibilities. Investment 1 is the 2-year CD. Investment 2 is the 1-year CD, and roll over into another 1-year CD. So we could actually do this for a 3-year, also. So this is a 3-year CD return. And suppose that an alternative strategy would be to buy a 1-year CD and then roll over into a 2-year at the end of the first year. And 1F3 is the annual rate on a 2-year CD available 1 year from now that exactly delivers the same return when combined with the 1-year strategy that's available today as the 3-year buy and hold. Yes? No. Not exactly. So I'll try. So this one here tells us what rate you need to get on a 2-year CD that's available 1 year from now. When you combine that with the 1-year CD that's available today to exactly get the rate of return of buying 3-year CD today. Yes?
Conceptually, this is, we put $1,000 in the CD. It gets a return as that's the first 1 plus 0 or 1. And then we invest everything from that CD into another CD that is 1,000 plus the interest. And that one holds for 2 years. And we know everything in that equation except the nth grade.
Exactly.
Which we're trying to work. Okay.
Right. So we know everything's got a 0 on it. We know today. Right? Because I know what the 3-year rate is. I know what the 1-year rate is. But I need to solve for this other rate. This other rate we solve for it exactly equates to the strategy's returns. Yes?
Could there be multiple answers? If instead of rolling over into a 2-year, you roll over to another 1 year and then roll into another 1 year, or those rates can be different?
Well, let's think about that. Suppose I can write this. It's definitely true. I can write this as 1 plus 0R3 cubed equals 1 plus 0R1 to the power of 1 times 1 plus 1F2 to the power of 1 times 1 plus 2F3 to the power of 1. And I know 0R3, I know 0R1, but I got a bit of a problem. You see what the problem is? 2 unknowns. But it's valid. I write it like that. It just so happens that I can't solve for it.
I was just thinking about what expectancies of future interest rates in the future you might expect to be increasing in the future. And the rate you get in the 3rd year might be higher than a 2-year CD.
That's right. So you could consider that. And actually, if I gave you this information here, then we could do exactly your calculation. So now I've got 2 equations. I can figure out what the 1F2 is, right? And I could use that to, then there'd be only one unknown down here, the 2F3. So, you know, like, what's going on here? Like, why is this interesting, or why is this relevant? Why would you want to go, like if you're choosing between the 2-year CD or rolling over the 1 year, like what are the factors that are going on here? What is the use of that forward rate calculation? Yes?
It would be that you, what it's telling you is that if you just lock it in for 1 year, you better expect that you're going to get a rate that's better than that forward rate at the end of that first year. Otherwise, you might as well lock it in for 2 or 3 or whatever the situation.
View. That's what you're saying. So let's say you've got a view on the interest rate structure, similar to Chris's point too. So you think that, let's say interest rates are really going to go up, right? You calculate the forward, let's say you're right up here, and you calculate the rollover rate that you need to get to exactly match the 2-year strategy, and let's say it's like 9%. But you really think that the 1-year rate, 1 year from now, is going to be like 11%. So then it would make sense, perhaps, to undertake the rollover strategy. Makes sense? No? Anything else?
Could you go through the notation one more time to explain the, so I can read the subscripts and understand what they actually relate to?
Yeah, so let's do the this one right here. So this is just the 3-year CD rate that's available today. That's times 0 subscript. And 3, which follows, is basically the maturity of the CD. So that's one investment strategy. It's an annual rate that I'm quoting here. And 0R1 is also an annual rate, but it's for a 1-year CD. And 1F3 is a 2-year rate that begins at the end of year 1. Okay, so it goes between 1 and 3. It's also an annual rate, so that's why we take it to the power of 2. Because we're getting this annual rate twice. So that's how the notation works. Is that okay?
Much better.
Yes.
That annual rate of power of 2, I mean, that could be for anything, right? If it was semi-annually, it would still be the power of 2 because it's the number of...
Right, so let's do the semi-annual, which is next. So this is a rate between year 3 and 4.
Yeah, the periods.
So now we're operating with the I, which is the effective periodic rate. Okay, so this is a strategy of investing for 4 years. And we're compounding every 6 months. And we're comparing that to a strategy of buying the 3-year CD, which has a return here, and rolling over into a 1-year CD 3 years from now. Okay? And notice that the power is to 8 here, which makes sense because I've got 8 periods. This is a semi-annual rate. And 6 here because it's 3 years, and 2 because it's 1 year. To get the stated or the APR equivalent of the forward rate here, multiply by 2 after I solve for 6F8. And I think that this question is relevant for assignment number 1. The semi-annual rates. There's something directly on assignment 1 where you need a formula like this. Yes?
I mean, just a question regarding that. The way you would solve that would be to get the non-F terms on the left-hand side and then take natural logs and end up. That's the way you solve it.
You could take natural logs.
You think square root of that would be exactly 2.
You know, you could do everything in logs, but probably not. Well, if you do the logs, then you have to undo the logs later on.
Right.
But yeah, so basically solve for this thing here, right, which is just going to be this term divided by this term, right, and then take the square root of the left hand side.
In the assignment, you end up with that to the power of 30, so you're no longer taking. It's not easy in Excel to take 30 as a root of something.
It isn't.
Sure you can.
Yes, so just what?
There's function.
Yes.
Y to X.
Caret.
Yeah.
Caret raised it to the 30, but what about taking the 30 at the root of something?
1 over 30. 1 over 30.
Cool. Okay.
Yeah.
Easy. So I didn't go hard here.
Okay. Yeah. Well, you can do it in logs, right? It's simple to do it in logs too. Right?
That was a lot. Not quite.
But you have to get back them and unconverted and stuff like that. But yeah, the logs. This is just you add things, right?
Yeah.
Well, I don't want to get sidetracked into logs yet.
No.
Okay. The last thing that I want to talk about today, into the quarter two. The last thing is the alternative interpretation of the forward. Okay, I'm going to go through this, and what I want you to do is to make sure that you really understand this, over the weekend. Okay, because It's a little tricky. Okay, we find a 1-year zero trading for $100, our face value of $100. 1-year zero at $100 wouldn't be that attractive. It's trading at 92.59, and the yield is 8% annual, no semi-annual compounding to make it simple. And there's a 2-year zero that's trading at 79.74. And that's got a yield of 12%, and again, assume no compounding. And this is what we're going to do. We're going to sell or short 100 million face value of the 1-year bond. So we're going to be like the government. We're going to issue or take a loan. Okay? And we're going to use the proceeds of that. The proceeds are going to be like 92.59. We're going to use the proceeds to purchase as much of the 2-year bond as possible. Okay, so we've got $92.59 million from the strategy of selling the 1-year bond. And we're going to buy as much of the 2-year as possible. The 2-year is trading at 79.74. And it turns out that it's kind of a magical transaction because no cash goes out for this. But in order to get a return, we actually have to invest at some point. And suppose that we're going to have money to invest, not today, but in 1 year. Okay, so we're doing a transaction today, but we don't have any money today, other than we know we're going to have some money next year. So at the end of the first year, we have to pay back our loan in terms of the shorting the 1-year bond. So people have given us 92.59 with the expectation that they're going to get 100 back. So we have to pay that back, and we've done a fair bit of this bond, so we have to pay $100 million back. And I'm assuming that we've got $100 million to do that. What's left over is this 2-year bond that we originally invested in, which now has 1 year to go. Okay. And what I want you to think about is calculating the return on that bond. I can show you how to do it, but I really want you to understand all of the cash flows and where they come from. And even after you understand cash flows, change the numbers and do it again. Okay, so let me recast this example. This is an example where you know you've got some money coming in next year. It's quite a realistic example. It could be a pension manager or something like that where you know with a fair degree of certainty that you've got some cash coming in next year. However, you want to do something today to kind of lock an investment in. And what we're going to do is a transaction that involves buying something and selling something at the same time. You might think, well, how can I just personally go out and sell like $100 million of this 1-year bond? How is that possible? And it turns out that if you say you're going to use the proceeds to buy a 2-year bond, it's not really that risky. If you said that you're going to use the proceeds, the $92.59 million to go to Vegas, then it's unclear that anybody would give you the money, right? Because their expected value is going to be far lower. Yes?
Why would they like to use getting it from the government?
Well, maybe slightly different, or maybe it's a government bond. Okay, so I could be, selling a government bond to you. It happens all the time. Or I could sell you IBM shares, and even though I don't own them. That's the idea of shorting. And we'll talk more about shorting, but the idea is you're selling. You get the cash flow, you're going to invest, and lock in an investment today. We're locking in an investment today that is going to be paying off in 2 years. So go through this example. It's I think it's a nice way to view the forward rate and the economics behind the forward rate, and how you can actually use that rate in terms of investments. Okay, so I'll see you on Monday.